Bloomberg Audio Studios.
Podcasts, radio, news.
So, Allegra, we all know what the MPC is, Monetary Policy Committee at the Bank of England. Do you know what the FPC is?
Yeah, Financial Policy Committee, I now know. But I am not surprised it exists.
And they look basically at the financial shocks that institutions could go through, and they try and support them in understanding where the risks lie, but also how they can help with growth.
Yeah, I mean, it must be quite an exciting / terrifying role to have to imagine the very worst shocks, even worse than we've seen already, that the banking system could endure.
So there was a big report that came out on Friday. We're going to get into the latest report and dig deep to understand what it means for financial institutions and where the big risks lie, and why this time it's a little bit different.
Welcome to the City of London.
The City of London.
The next station is Bank. Please mind the gap between the train and the platform.
The financial heart of the country.
The City.
The City.
Welcome to In the City.
Stand clear of the doors, please.
I'm Francine Lacqua.
I'm Allegra Stratton.
And this week, a look at the recent Financial Stability Report, what it tells us about how prepared finance firms are in times of a crisis. And with us, Nat Benjamin, who's appointed Executive Director for Financial Stability Strategy and Risk, and of course is also a member of the Financial Policy Committee. So Nat, thank you and welcome to In the City.
Thank you very much. Thank you for having me. It's a pleasure to be with you.
Talk to us a little bit about the FPC.
There's a number of ways in which the Bank of England watches over risk to financial stability. And one way of doing it is to ensure that individual institutions within the financial sector are safe and sound. But another way to look at it is to check that the sum of the parts adds up. And only focusing on individual firms is not going to be enough. And that is the focus of the Financial Policy Committee, which is to ensure that the system as a whole, the financial sector as a whole, does its job of ensuring vital services to the real economy, to households and businesses, people's ability to save, to pay, to borrow what they can afford, to invest, and to insure themselves. So that is the focus. And systemic risks are the focus of the FPC. So what do? Well, we work to spot them, to track them, and to take action to address them. And every quarter we get together and we see what we think about the key outlook for financial stability at a given juncture, but also we consider more structural issues with the financial sector, longer-term issues. And that is what we did last Friday.
How do you look at some of the risks out there?
We had quite a lot of things to say last Friday. First, the state of the conjuncture at that particular point in time, but also we had published the results of our stress test of the banks. We had done a desk-based stress test of the banks to check they were strong enough to support the real economy, both in good times and in bad times. We had also completed and published the result of our system-wide exploratory scenario. So that was quite a pioneering initiative. I don't think it's been done before, and we're very proud of it. And this is the first time we stress test the entire financial sector, or one part of the financial sector rather, not just the banks or just the insurance companies. And it's very exciting.
So it was 400 pages, right? 450 pages.
I'm surprised there was that few.
Allegra read it all.
And what does it show? I did read it all, but you should, in your own words, what does it show?
So the first thing was just to show the value of such exercises, where instead of just shocking the system and seeing what happens, we don't assume the reaction function of different players in that ecosystem. We do a flow test. So we actually ask them how they would react. And then in the second round, we factor that in to see how a shock plays out. We impulse a shock on markets that are core to the UK economy, and we see how it plays out.
And Nat, what shocks?
Several different markets, different variables, market variables, interest rates, credit variables, very severe stress. And in combination, it's probably more severe than anything we've seen before.
Including the financial crash.
Including financial crash. And we applied that to markets that are core to the economy, like the gilt market, the gilt repo market, and the sterling corporate bond market, and associated interest rates derivatives.
And even in that scenario, that higher stress scenario, worse than the financial crash, did the UK economy stand up to it or fall over?
So what we tested in that system-wide exploratory scenario was the resilience of those core markets. And the good news was that market was proved to be more resilient than it was before. That was a positive news. But there's no reason for...
There's always a negative, isn't there?
Exactly. Well, there's no reason for complacency because those things can change fast. So what we need to do is to ensure we lock in that improvement in resilience to deal with whatever the future can bring. That is one conclusion. But the other thing we found is that there was a very large redistribution of liquidity across the financial sector between participants. And the other thing we found is that the behavior of market participants amplified the shock, made it worse.
But you also warned that basically hedge funds, right, asset managers and pension providers could be unprepared in times of crisis.
So that is...
there's a part of the financial system which is much more risky than the rest.
That is the fact. And I mean, that is the value of those exercises, to put the spotlight on these things in peacetime so that everyone gets prepared for when shocks happen. So I'll give you an example. What we found is that a number of market participants, for example, hedge funds, were assuming that if the shock happened, they would be able to get extra repo from their banks. And actually, we asked the banks, and the banks said, no, there's not going to be more repo. That's an interesting finding. We fed it back to the hedge funds participants so that they can factor that in their own risk management, in their own stress testing.
And I remember being told that, shadow banking was the biggest hotspot when interest rates would go up. But we haven't really seen that much blow up.
Well, if you look back at the last 5 years, and I think about those last 5 years as a period of transition away from the post-global financial crisis area, which was very unique in many respects, into a new norm. We're transitioning. And there has been bits of turbulence over the last 5 years. Actually, it would be a bit bizarre if there hadn't been. But every single time we think about Archegos, you think about the dash for cash, you think about LDI, think about nickel, every single time the shock was amplified by those vulnerabilities, by margining practices, by the fact that haircuts used to be zero and they ramp up very suddenly. And the margin call comes, and it's a big margin call, and the counterparty scrambles around for cash. And that can have a very destabilizing effect on financial stability, and especially on the markets on which those strategies are anchored. So that is why, in particular, the international policy work, which is aiming at those vulnerabilities, is particularly important. And it's important that these things are sorted out in peacetime so that, when the shocks happen, well, there isn't such a ramp up in the size of the calls or the liquidity.
So it sounds like you have a function to sort of teach some practitioners across the City of London. Do you bring them in and say, this is the evidence from our analysis and our exercise, and we suggest you behave differently in future?
Well, you see, this has been a really good aspect of this particular exercise. It's just the tone of the conversation. It's not an exercise we've done to punish anyone. It's just an exercise to find out what would actually happen. It is not just in the interest of the Bank of England to ensure those markets are resilient. It's in the interest of everyone and of all the participants because they do business in those markets. And the quality of the tone of the conversation was really good. And we got really good feedback from the participants because what we've been doing is to be almost maximalist in how much we share back to them from what we learn.
We've talked a lot about how the system might handle the shocks, but let's talk about those shocks. And you keep talking about peacetime. But it's actually quite a fraught geopolitical environment right now. When you look at the news, when you look at the developments out of America, out of Europe and so on, these are the kind of shocks you're talking about the system handling, as well as more sort of acutely financial ones, aren't they?
That's right. So, one of the things we set out last Friday is that global risks are high and the uncertainty and the degree of risk around the outlook has increased. And it matters particularly because the risk of global fragmentation is higher. And fragmentation is not good for trades, for financial markets, or for international collaboration and cooperation. And there was already pressures on sovereign debts in a range of advanced economies, and those pressures have increased. So yes, the outlook, the global outlook has become...
But it's tricky, isn't it? Because you published last week, but in some ways this is a watching brief for all of us, knowing exactly what the complexion of the Trump decisions and so on will be. Does that not matter? Did you model, for instance, a tariff regime of X% on UK exports and imports being affected too?
I mean, this is not about any one country in particular. This is a global phenomenon. And on tariffs specifically, it's too early to tell the impact that tariffs can have. It depends on the reaction function of different jurisdictions. It depends on the actual channels that it takes, whether it causes inflationary pressure, whether the impact is on exchange rates, etc. And it is not clear-cut, it's not obvious that tariffs in and of themselves might have impacts on financial stability. Global fragmentation, however, isn't a good thing for financial stability, that is for sure.
I mean, we had a big shock in the UK, frankly, because of pensions under Liz Truss. Could that happen again? Or have they taken provisions for that to be tamed?
Well, one of the things we did test as part of the system-wide exploratory scenario is the gilt markets and imposing a shock on gilt markets. And we had over 50 participants in the exercise, including pension funds and LDI funds. And what we saw is that they had built that resilience since the events you described, and they had higher liquidity buffers, which meant that they were better able to manage that shock. However, as we discussed earlier, there were other pockets of potential risk that needed to be addressed and managed, and those actions are being taken forward. So it's really important that all those improvements are locked in, as I said, because things can evolve.
Nat, do you believe that actually a lot of these actors, the hedge funds, the asset managers, will look around and say, actually, we need to minimize risk?
I think part of the advantages of doing exercise like that, where we had great engagement from participants like hedge funds and asset managers, is that it put the spotlight on some of the risks. It put the spotlight on the situation in which actually they might take a loss. And that is something they can then factor in their own internal contingency planning, their own risk management, and their own stress testing. So that is an important aspect of it, so that if shocks do happen in the future, their impact is lower and is contained.
Can I ask you about regulation? Because we're, again, as Allegra alluded to, we're at this juncture where we don't really quite know what the US does. If they deregulate the banks, if they deregulate some of the private companies, some of the private equity, some of the credit companies as well. I mean, does that put the UK in a difficult position to decide what to do?
Again, this is not a question about any one country, but there are calls at the moment for deregulation. You can hear them everywhere. And when I hear that, I cannot fail to just go back in time a little bit. And I remember the mid-2000s, where there were calls for deregulation. And quite frankly, it made our job more challenging as regulators and supervisors. And then the next thing that happened was the global financial crisis. And that crisis resulted in a considerable loss of growth for many major advanced economies, including the UK. And way beyond the immediate terrible impact for households who were losing their homes. But these things cast a very long shadow over time. And so I think there's a lesson there. Calls for deregulation may sound very appealing in the short term, but longer term, the people who pay the price for it are the people, the households and the businesses. So it's quite important that we remember those lessons from history as we look ahead. So having talked about deregulation and the fact that we need to not forget those lessons from the past, there is a very legitimate question about whether the financial sector is doing enough to support growth generally. And I think that's a very legitimate question to ask. And in particular, in areas like payments innovation, support for climate transition finance, or the reform of the pension system, those are areas where it's worth asking the question of whether there is more the financial sector can do to support growth.
It's a good question, but it's either you go the US style, which is free market deregulation, or you force some of the institutions to do some of the things that could eventually help with growth?
I think the idea is to be mindful of those lessons from the past and step into the future, but in a safe way.
How's the interaction between private sector and the bank? Do you feel like you understand? Yeah. Do you feel like you understand each other?
I do. So in my previous job, I was supervising foreign banks in the UK. And in the past, I was very involved in supervision, so direct bank supervision. There's a good degree of engagement. If I take a step back and I think about what I want the UK to be known for as a place to do business and what I want the UK regulators to be known for, I want us to be known for the fact that people feel they can talk to us, that we're approachable, we can have a conversation. I want us to be known for actually not kicking up a fuss for nothing. So when we do have an issue, we say we have an issue and we mean business and we know what we're talking about. We will not be kicking up a fuss for nothing. We'll be proportionate. And I want us to be known for a place where we're predictable, so we don't spring a surprise on people and people know what our reaction function is. So those are the type of things I want the UK to be known for. And I think that enables a really good dialogue. And actually the quality of the dialogue we've had in this system-wide exercise has been really good from that perspective.
We talked about shocks from politics and geopolitics and so on, and your survey shows that's what companies are worried about. They're worried about that. They're worried about cyber risk as well. But just quickly on households, the evidence from, I think, your report is that British households are resilient and they're doing okay. They're absorbing the increase or certainly elevated mortgage amounts. But how long does that last? How long do you think you're confident that they will remain if we have higher interest rates for longer?
I mean, part of the transition we're going through is that it's the real economy going through that transition with higher interest rates. And overall, as you said, the picture is that it's been a challenging time for households, but they've been resilient in aggregate. And there's still a material proportion of households with mortgage, for example, who will have to refinance on higher rate than they have at the moment. But what we've seen is that for those that have to refinance on higher rate, the average increase in monthly costs to repay their mortgages is lower now than it was projected to be in June, for example. So these things all depend on the key of market rates. But
so lower, but still higher.
So there is a wall coming, but it's a lower wall than it was in the past, in a sense. So far, they have been resilient, and we don't see any reason for that not to continue. One thing we have observed, we talked about why financial stability matters, is so that the financial sector can support households. And unlike 2008, where banks made things worse and amplified the shocks, what we've seen recently is banks supporting households through those difficult times. For example, by giving them 6 months to switch on interest only to repay their mortgages, to give them time to absorb the shock and then reverting back to full repayment. So those are the type of things that a strong banking system can do to help the economy through a difficult time.
The other shock would be a climate change shock. And I think it used to be a priority. It is not anymore because of geopolitics and cyber and so on. But I presume you're still looking at it and still feeling that the banks and financial institutions can cope if there's a big climate shock. Yeah,
definitely. And we also published a refreshed approach to the climate risk impact on financial stability. An interesting thing with that is that climate risk is not just a long-term thing. There are also shorter-term issues and risk to financial stability coming from climate, either from floods, for example, which affect insurers and reinsurers, and also banks, to the extent that homes that are subject to flood risk are being the collateral for mortgages. Another example is from climate transition risk, where some metals are being more needed for climate transition, and there's more pressure on those markets, on those commodities markets. And we've seen over the last few years a few shocks around those markets, and those impact commodities trading, impact the derivatives associated. So those are examples of shorter terms financial stability risk to climate, and it's important to keep monitoring those things, and we'll be incorporating those things as relevant into the stress test that we do in the future.
Nat, I guess the difference is, I remember like 10, 15 years ago, some of these stress tests, felt for me like a young reporter at Bloomberg as completely far-fetched. It was like interest rates at 10%, at 12%. And now actually a lot of the stress tests seem to us quite plausible in worst case scenario. How do you deal with the fact that some of these stress tests could be actually,
real life quite soon?
Yeah, real that could actually happen instead of being the far-fetched scenarios?
Well, I think we've always sought to, use scenarios for our stress test that were severe but plausible. And just to give you an example, we just published the result of our desk-based stress test of the banks. We've used 2 different scenarios, mutually incompatible. They can't happen at the same time. One is interest rate going up by a lot, and the other one is interest rate going down by a lot. And we're completely agnostic about which one is more likely than the other one. We just apply those two scenarios and see what happens. So that is part of what we do to deal with what you just said, is to be more exploratory in our nature so that we don't have to speculate on what might happen. If it happens, what's the consequence?
Nat, thank you so much for joining us. That was great.
Really interesting.
Very well explained.
Thanks for listening to this bonus episode of In the City from Bloomberg. It was hosted by me, Allegra Stratton, and Francine Lacqua. It was produced by Summer Sadi, production support from Moses Andam, and sound design by Blake Maples. Brendan Francis Newnham is our executive producer. Sage Bauman is head of podcasts. Special thanks to Nathaniel Benjamin. Please subscribe, rate and review wherever you listen to podcasts.